Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, April 10th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro events are sticky inflation replaces immaculate disinflation as a key driver of asset markets, plus fresh evidence of our green shoots globally theme. So the nuance there is the March CPI report disconfirmed the immaculate disinflation theme and suggests our sticky inflation theme has replaced it as a key driver of asset markets. Most notably, core CPI of 0.4% month over month beat the consensus estimate of 0.3% and represents the third consecutive month of greater than or equal to 0.4% readings for the first time since the 3 months ending in February of last year. Elsewhere, the growth rate of Japan machine tool orders, which is a stealthy and stable leading indicator of the global industrial cycle, accelerated to minus 3.8% year over year in March, which is the highest level we've seen since December of 2022. In terms of market applications, incremental evidence of our sticky inflation theme supports our view that the last mile of disinflation required for the Fed to achieve its price stability mandate will be difficult to traverse in the absence of a recession. Since the summer of 2022, we've been consistent in our view that inflation was likely to bottom at a level inconsistent with a full cycle mean of 2%. Perhaps we have seen the bottom. Our Jay and Janet want a soft landing theme is likely all that is standing in the way of a row phase transition here in Q2, because risk assets likely require far more than mere green shoots from the world's major economies to power past current valuations. And when we say row, we just mean going from risk on to risk off or vice versa. Obviously, this will be a risk on to risk off transition. So transitioning to our 42 macro dashboard here, as always, I'll wrap up with a question from our community. Questions about the jobs report. It says, what are your thoughts about the narrative that the jobs report is misleading because it is mostly maybe more part-time jobs and the actual number of full-time jobs are falling? So when it comes to the jobs report, what we care about is not part-time jobs, full-time jobs, jobs in general. What we care about is the amount of income that workers are generating from the labor market. And when you productize employment growth, and we look at household survey employment and establishment survey employment, take the mean of that so that we're not biasing our analysis of the employment on the birth death model. So we take employment growth, the productization of average hourly earnings and average weekly hours, and we net out and we wind up with the result of 6.3% through annualized private sector income growth coming out of the labor market for the most recent month, which is March. The most recent month is March. So that 6.3% compares favorably to a completely different statistic that we get out of the PC report at the end of the month, which is nominal employee compensation, which is the broadest measure of income that we generate in the labor market on a monthly basis. Nominal employee compensation is also running at around 6%, it's currently 6.1% on a 3-month annualized basis. So those numbers, the nominal employee compensation statistic has consistently confirmed trend or at trend private sector income growth from the labor market. So in our opinion, we think, just the narratives in general that are out there on finance Twitter, Zero Hedge, finance bear porn podcasts, those narratives are really good at getting you to click and getting you to think and getting you to miss out on bull market and very good at preventing you from retiring on time and comfortably. But what they are not good at is helping you make and save money in financial markets across the full investing cycle. In our opinion, I think you would do well as a retail investor. Certainly, I would say you suggest you do well as any type of investor, retail, buy side, anywhere, to avoid being, to avoid the deluge of bear porn that comes on a daily basis. Because again, that stuff is how they sell ads. The people who put bear porn into your inbox or bear porn onto the platforms that you consume them on are selling you advertisements. They're not selling you retiring comfortably and on time. That's not what they sell. They sell clicks. And so you need to be aware of that when you're consuming that kind of media. I'm not saying there's anything wrong with that media. You just need to be aware of that in terms of how you're managing your portfolio risk. Risk management is very different than being entertained by bear porn. You can be entertained as much as you want by bear porn. I highly recommend it. It's extremely entertaining. But when it comes to making money and protecting gains in financial markets, you better have a damn very good systematic risk management process. And I think that's what we do really well here at 42 Macro, is separate the signal from the noise. So we'll wrap it up there. Darius Dale presenting our macro minute for Wednesday, April 10th, 2024. For clients of our Macro Strategist Pro and above tier, will be able to catch us live at noon today. We got our friend David Hunter from the Contrarian Investor joining us this afternoon. So very much looking forward to that. David's been right as rain on the bull market that we've experienced over the past couple of years. So just going to pick his thoughts here, just given some of the changes in some of the fundamental narratives. So looking forward to that. Catch you back here tomorrow. Cheers.